Welcome to another video in our Taking Care of Business series. In this video, I'm going to share with you some general tax planning strategies we use with our business clients. Of course, this video certainly doesn't substitute for professional advice because everyone's taxation circumstances are different. However, the content will give you an overview of how you can reduce your tax liability within the framework of the Australian tax laws. Firstly, there are some basic tax planning concepts that every taxpayer should consider, including the opportunity to defer income to future years. For example, if you operate on a cash basis and your cash flow allows it, you might consider delaying raising invoices for work completed in May and June until after June 30. This means you obviously don't get paid until after June 30, but the income is deferred to the next financial year. Another common strategy is to bring forward some tax-deductible expenses that you know you will incur in the new financial year. For example, you might bring forward some repairs and maintenance expenses, staff bonuses, or donations to the current tax year. In some cases, you might also be happy to prepay some monthly costs, such as subscriptions or rent, but please be aware that the ATO have special rules regarding prepayment of expenses. Another expense you can bring forward and pay before June 30 is staff superannuation guarantee contributions. These contributions must be paid by July 28. However, if you want a tax deduction in the current financial year, you need to pay these superannuation before June 30. Note that the transfers or deposits must clear before June 30, so we always recommend you pay the contributions a few days before June 30. On the topic of superannuation, business owners should also be aware that the maximum tax-deductible contribution for 2018 financial year is $25,000. The potential tax savings from maximising super contributions for a typical mum and dad business can be substantial. And remember, contributions into your super fund are only taxed at 15%, rather than your marginal tax rate that could be around 47% if you earn more than $180,000 per annum. Next, the $20,000 accelerated depreciation write-off provides small businesses with a huge opportunity up until 30th of June 2018. The concession provides qualifying businesses with an immediate tax write-off for individual assets costing up to $20,000 each. In the 2018 financial year, businesses with an aggregate annual turnover of less than $10 million are eligible, and it's important to note that this scheme effectively brings forward a tax deduction that your business would otherwise have been able to claim as depreciation in future years. As such, it provides a significant cash flow advantage. If you operate on an accruals basis, you should review your debtors in June each year and write off any bad debts before June 30. These bad debts will effectively become a tax deduction, but they must be physically written off before the end of June, not a few months down the track when you get around to doing your tax return. You should also make sure that the debts have previously been included in the business's assessable income, so this strategy won't apply if you operate on a cash basis where you only recognise income when it's received. If you have trading stock, each stock item can be valued for tax purposes using the lower of cost, market value or replacement value. Obsolete and aging stock that is written down will effectively reduce your profits, and remember, the stock value is always exclusive of GST. In summary, before you implement any of these strategies, we always recommend you consult with us first. Tax planning is a process that requires an understanding of your business and personal circumstances, and we usually recommend you prepare an interim set of financial statements to get an idea of your likely year-end tax position. Until next time.